Hello, everyone. I'm Carolyn Moore from Modern Widows Club. And today we have a special educational webinar for you. It's about Social Security for widows. And we have a special guest today. And I'm just going to read a little bit. Kristina George, hi.
Hi there. Hi, everyone.
Well, let me share a little bit about the experience that Kristina has and why we actually chose her. First of all, she's involved with our New Hampshire community here at Modern Widows Club. And I saw that they did a breakout, and I said, this would be really great to share with the whole Modern Widows Club community. I mean, let me tell you a few credentials that Kristina has. She is a wealth manager at Northstar Financial Planning in Windham, New Hampshire, and I've been there and it's beautiful. Northstar is a fee-only financial life planning firm that specializes in working with people who are in the midst of a life transition. Their clients are often in the process of either divorce or newly widowed. All of the advisors at Northstar have had specialized training from the Sudden Money Institute to help their clients manage financially and emotionally during times of transition. I've also met all of them and they're excellent. Kristina is a CPA with more than 25 years of public accounting and personal financial planning, along with the credentials of the CDFA, which is a Certified Divorce Financial Analyst. She has a master's of science in taxation. Wow, okay. She is also collaboratively trained financial neutral and trained mediator in the state of New Hampshire. She is currently serving on the board of directors for New Hampshire Collaborative Law Alliance. Kristina earned her bachelor's degree in accounting from Bentley University, her MST from Northeastern University, and her CFP certification from Merrimack College. She is a member of the American Institute of Certified Public Accountants and New Hampshire Society of CPAs, the Financial Planning Association, and the Collaborative Law Alliance of New Hampshire, which is a mouthful.
Wow,
but bottom line, bottom line, she knows what she's talking about. Okay, so we're just going to jump right in. Here's what the format's going to be. I'm going to turn it over to Kristina. She's going to go ahead and start her presentation, and then after that, we're going to start a Q&A. Now, if you have any questions during this, make sure that you put them in the chat, because I'll be checking that, and I'll also be adding some links in there, how you can get a hold of Kristina, the link to her firm, and things like that. So I'm going to turn it over to you, Kristina, and spotlight you here. There you go.
Gosh, thank you so much for that introduction. It really is a mouthful, isn't it? Sorry about that. I give you the long version. But I will share, Carolyn, one of my favorite topics is Social Security, because it's that important and it is complicated. And so I see there's a couple folks trying to join. And so I'm going to let you mind the waiting room, and I'm going to share my screen and get right into it. This is a topic I could talk about all day long. So the timing is going to become important. You're going to have to stop me, okay, at about 20, 25 minutes in, to make sure that we have room for questions for folks, okay? So Social Security planning for widows, for children, super important. What we know is that, I'm not telling you anything you don't know, women have lower lifetime earnings. It's because of years out of the workforce. We're generally taking some time off to, help with kiddos, get them up and out, help with parents, okay? We have lower pensions because of our lower earnings, and we live longer. I'm not telling you anything you don't know. So this is a problem as far as our Social Security benefits that we're entitled to, okay? It's a reality. When we look at Social Security benefits, there's going to be a lot of jargon. So jot down some notes. We'll talk about where to get your questions answered and some resources, okay? But the very first acronym that the Social Security Administration likes and will use when you're applying for benefits is FRA. It used to be called NRA, normal retirement age. But we need to understand this concept of full or normal retirement age. It's the age where you can claim full unreduced benefits. A lot of people think 62 is when you're going to claim benefits. And if you do that, your benefits are permanently reduced by 25%. I've had so many folks come into the office and say, well, when I reach my 67 or whatever my normal retirement age is, my benefits will increase. Not so. That discount, that haircut stays with you for your entire life. So you just need to know that. So all that to say, if you're born between 43 and 54, your age is 66. And then you can see the years thereafter, full retirement age increases ratably. And then there's also talk by the administration of increasing that 67 up to 70 and even further 72. Okay, so find where you are in this chart, figure out what your normal or full retirement age is. That's the first important concept. The next acronym, because we are dealing with the government agency, is PIA, primary insurance amount. Your monthly benefit is going to be the culmination of your 35 years highest earnings. Well, a lot of us can say, you know, we dropped out of the workforce. I might only have 20 years of earnings. The other years when you don't have taxable income are filled in with zeros. So when we're calculating your primary insurance amount, which is your monthly benefit, loosely, what we need to say is what you've got on record for monthly and annual earnings. You've seen this statement, I bet. Each year on your birthday, the administration sends out this statement. It's like a fourfold with the green writing, okay? Each year, your benefits are projected based on the IRS sharing your tax return with the Social Security Administration, okay? So your earnings are trued up every year. So when you're looking at what this benefit is projected, you're never going to get less, but you may in fact get more, okay? If you continue to work, your earnings will be increased. And if you have a high earning year, one of the zeros or one of the low 35 years will drop off. So you can always do better for yourself, okay? The biggest question I have are folks coming into the office and saying, when should I apply for benefits? So first, it's how do we calculate the benefits? Second, what should I apply for? When should I apply? Okay, we just talked about early claiming. Your benefits will be reduced. And remember, after 65, your Medicare premiums are paid out of your Social Security check. Okay. Additionally, I want to show this chart. The PIA is 100% of your benefits. Here's your reduction if you apply early at age 62. Okay. If your full retirement age is 67, I mean to say, you will get 100% of your benefits. Okay. The opposite is also true. If you delay benefits between your normal or full retirement age, let's call it 67. If you delay until 70, the Social Security Administration will pay you about 8% per year to defer. This is also called delayed credits. And yes, they talk in jargon. And so we need to know these terms when you go into the office or you go online to apply. So when we're running calculations for folks, we really want to preserve the higher amount of benefit because every year, here's another term, COLA, your cost of living adjustment. Your COLA is based on the benefit when you started. And so if I were to defer and delay my credits and earn 124% of my benefit, my cost of living every year, which is set by the inflation rate every year, and generally it's about 2%, will be applied to that higher benefit every year. So what we're doing by delaying, if we can, is it's a hedge against inflation. A lot of folks will say, Social Security is gravy. It's not going to mean anything. It's only a small part of my portfolio. Well, it's a benefit that you can't outlive. If your portfolio depletes, Social Security is going to be there until your end of days, and it's going to be cost of living adjusted. Okay, I'll get off my soapbox about that. Okay, so that's why we delay the benefits. Okay, the first chart was a percentage, and then this one, it translates into dollars amount. I know it's hard to pass up the Social Security checks when you turn 62, but the longer you live, the more income you'll have by waiting to apply. Okay, and you can see exactly the benefit. If you claim at 62, the highest you'll get up to is 4,400. And again, that compounding, if you wait until 70, you'll be getting, gosh, almost 8,000 a month. That's a big difference. That can really change your month, no doubt. Okay. I know that on this call, we've got survivor benefits, and I want to make sure we get your specific questions answered about this. So our call is focused on survivor benefits, how they're calculated, what your options are. Okay. It's really important to understand your options. You can claim survivor benefits as early as 60. If you happen to be disabled, you can claim at 50. Now that's far different than a worker's benefits, right? 62 is the earliest you can claim, okay? If you claim at age 60, your benefits reduced, okay? So you might not want to automatically file for benefits as soon as you turn 60. There are very few decisions that are irreversible, but this is one of them. And so what I love to hear is clients coming in and saying, guess what I'm thinking of doing, instead of guess what I just did, because there are very few exceptions to undoing your Social Security claim and amending, putting it on a hold. I have sat in the local Social Security office with clients for 6 and 8 hours trying to reconcile benefits and make sure we undo a claiming strategy that they didn't understand. You know, of all the things going on, this is not the kind of chaos you want to invite into your life. So be really mindful. I don't want to be an alarmist, but be really mindful about what you're getting into when you apply for your benefits, okay? Analyze all of the options before deciding when to file, okay? You all know, to qualify for survivor benefits, you must have been married to the person who died. Living together doesn't count. There's no common law for Social Security. If he passed away during the marriage, you only needed to have been married 9 months unless there was an accident, okay? If your ex-spouse has passed away, you must have been married at least 10 years to claim survivor benefits on an ex-spouse, okay? So let's talk about the survivor benefits. We know what PIA means. That means you get 100% of your spouse's benefit at full retirement age, your full retirement age. That benefit is reduced if you file at age 60. It's reduced down to 71%. Again, you heard me say it stays with you. Here's the thing. If the worker, and we'll call the worker your husband, okay? If they claimed early, the widow's benefit is also reduced. And so my hope is public education. So getting in front of folks that are thinking of claiming, of course, before someone passes away, and really talking about how important it is to preserve the full retirement or even delayed credit retirement benefits for the spouse, because that's a hedge against passing away early and leaving the reduced benefit to the spouse. This is a very interesting, I mean to say quote, not calculation, it's a quote. 15,000 beneficiaries were eligible for widowers' benefits. This was as of September 19. However, they didn't apply for those benefits. They applied for workers' benefits. I know that's another confusing term. What it really means is they're leaving benefits on the table. There are benefits that women are eligible for that they don't know about, okay? And that's why we're going to talk about retirement versus widow or survivor benefits, okay? The Social Security Administration recognizes that there's a significant problem. People don't know what they're entitled to. They don't know what benefit they should apply for. There's a congressional research report from January of 2020 detailing what's being left on the table and how women are not benefiting from the benefits they're entitled to. I want you to hear that the administration has looked into this. They understand there's a problem. I know that these things are very slow moving. However, I do think that they recognize change is needed in this area. Women are suffering because they're not getting the correct benefits, and I'll tell you why in a minute, okay? There's a benefit update report that just came out in March of 2021. Of course, they have to quantify the problem first, so this is all calculations. And then this April 20th, Mitt Romney has just submitted a bill called the Trust Act. And from what I can see, it has bipartisan support. And really, I don't know the timing of the actions of these things, but I think that there's some national recognition from both parties that change is needed. Okay, so we're talking about retirement versus widow benefits and why we've got a problem here. When you go into the Social Security office, the people are lovely, right? They're very helpful. They know their job. However, Carolyn's laughing. Sometimes they're lovely. The ones in our area are. Okay, the point is, it's not their job to do long-range Social Security planning for you. They don't know what's going on in the rest of your personal finances, okay? Your retirement planning is cobbled together by pension, Social Security benefits, yours or your husband's, right? The higher of the two, not both, okay? Portfolio distributions, they can't advise you because imagine the lawsuits, right? That's advice and they just cannot do that. Okay, so analyzing your claiming strategies have to happen outside of that office because when you go in there, they'll tell you exactly what you're entitled to, but they won't tell you which one is better, okay? So that's why we've left so much benefit on the table, okay? So what we wanna do is protect your future benefits. How do we do that, okay? I also wanna touch on mother and child benefits because some of you on the call will likely have children under age 16. They also get benefits under the primary worker's work record, okay? That's 75% of the worker's primary amount. We know the benefits are cut off way too soon. The benefit is cut off at 18 if the child has graduated high school, or for some, our birthdays fall where we've got an 18 and a half or 19-year-old still in high school, okay? The survivor who's caring for the child gets 75%. The child also gets 75%. And it does get cut off before college. Again, I see that that issue is recognized in the report. We don't know what they're going to do with it, okay? We talked a little bit about how benefits get reduced, and that also happens by way of two things. There's a family maximum. So PIA, the primary insurance amount, that's the worker's benefit, okay? If there are several children under the age of 16, each person gets a benefit, but there is a family maximum, okay? And that, again, 150 to 180% depends on your other sources of income, okay? So this is a real earnings test with the family maximum. The reason each person's benefit is reduced and not just, not the family or not one person as a whole, as your oldest child graduates out, then the others get a higher benefit. Okay, so not too many people are in that position, but we sure do have a client that had 4 children underage, and so she was bumping up against the family maximum amount. Okay, anyone, survivor, worker, anybody who has applied for Social Security benefits under their full retirement age, for most of us it's 67, will have an earnings test. There's no way around this earnings test, okay? It's about 19,000, you can see that number there, for 2021. Every year that gets indexed for inflation, okay? What that means is if you're collecting benefits and your other sources of income, wages, self-employment, any other, income from activity is over that limit, then you have to give back $1 for every $2 owed. And I'm not saying don't work. I'm not saying, I just don't want to let the tail wag the dog here. But I want you to be mindful and know that that's a limit that's out there, okay? For most of us, the way that gets trued up is through your paycheck, right? The IRS is sharing the information with the Social Security system. For folks that are self-employed, imagine you go all year without sort of going on record about what your earnings are. And so then you submit your tax return. April 15th comes, they share the information with Social Security Administration, and then you get this letter that says, hey, we overpaid you, we want our money back. And so being really mindful about where you are mid-year in that earnings limit, that 19,000, is important. Otherwise, we're doing a major reconciliation, and again, sitting in the office and giving some money back, right? Which is just a lousy way to spend your time and money. Okay, but just be mindful about that, okay? One thing that you can do is put a pause on your benefits. So if you're receiving benefits and you find yourself in this situation, you simply turn off your benefits, and it will allow those deferral credits that we just talked about to accrue, okay? And then when you turn on your benefits later after your normal retirement age, that earnings test goes away, okay? Probably enough said about that one. I wanted to share that there are a couple changes that happen if you are remarried, okay? Your marriage trumps the survivor benefits, okay, before 60, okay? If you are after 60, the remarriage doesn't affect your survivor benefits, okay? So we've got the higher of the two, your workers' benefits or your survivor benefits, right? I wanted to share how to apply for benefits. And so I'll take a second and we'll take a little field trip over here and go to the Social Security website. They really want you to do everything online, socialsecurity.gov, and the area you want to be in is survivors benefits. Okay. They also want you to create, excuse me, an account, and that's on myaccount.com, my account in there. So without further ado, I'm going to get us over to there. So hopefully you can see my screen. If I type in the Googles, ssa.gov, I get myself over here. The place you want to go is in menu, and then over to survivors. Okay. You're going to find a lot of really good information over here about the basics of survivor benefits and how to apply. Okay. They do have some really good workbooks. And if you get tangled up, they do have an 800 number. Okay.
We can't see your screen. Are we supposed to see you?
Yes.
Okay.
Good. Let's share the screen again.
Okay.
Make sure. Thank you for saying that, because I'm just tooling around in this screen over here.
It's okay. We've got some good questions over here too. Thanks everybody for posting them. We're going to get to them.
Super. Let's get out of here. I'm sorry that I have double monitors, so I'm just, tooling around on my monitor.
That's what I figured.
Thank you.
You guys have some great questions.
Oh, good.
Is child benefit the same thing as survivor's benefit for my minor daughter that my daughter receives?
Yes, absolutely. Carolyn, can you see the Social Security?
Yeah, got it now.
Sorry, I isn't technology grand. So I go to the Googles and I type in ssa.gov and I get myself right here. Then I want to go to menu and survivors. Okay. Everything is in this tab here. It's laid out really nicely. The basics, the calculations, how to apply.
Okay. I don't think we went into the page. It's either frozen. Did you click on the link?
I did.
And go in? Yeah, that part I can't see.
Okay. Well, I don't want to belabor that. So I'm going to do the stop sharing. ssa.gov. There's some really nice tabs under that. It's called the basics of benefits. There's also a list of documents you need to apply. Okay. And that is really your marriage certificate, your death certificate, social security numbers, all the things that you would think. Additionally, your benefits are going to happen pretty quickly in the month after your husband's passing. And so have at the ready your bank account and the details for direct deposit, because they will really want you to have direct deposit for these checks so that the live checks are not bouncing around. Okay. So I feel like we missed a slide. And if there's time, Carolyn, how are we doing on time?
We're about 2 more minutes to the 30-minute mark.
Great.
And we've got probably about 8 or 9 really good questions over here.
Oh, super. I want to make sure we have time for questions. I did miss a slide because I was wondering when that came up.
There you go.
I want you to know the term duly eligible. Okay? Duly eligible means you have survivor or widow's benefit, and you have workers' benefit on your own work record. Okay, I know some of these concepts seem really outdated when we're talking about the terms. Remember, when Social Security was enacted many moons ago, right? None of us were born.
The 1930s and 40s.
You got it, right? So, well, none of us were born. However, most women stayed home. So it was designed to be a safeguard, a minimum benefit. Now we know a lot of women are working. So I want you to know that you have the choice between your own workers' benefits or your widow's benefits. And this is a pretty integral part of the planning, which is wondering why where's that slide? Okay. So what we want to do in the planning, if you are duly eligible, is determine which is the higher benefit, yours or your spouse's PIA. Okay. We know that when two become one, the benefits don't retain. You get the higher of the two, not both. So when you're doing long-term financial planning, that is significant. Stress test your plan. If one of you were to pass and the other have one benefit, what does that look like? So the math behind this is truly, if your benefit, we'll call it your PIA, is 2,000, your husband's 1,000, your ratio is 200%. Conversely, if your earnings, your PIA, are less than his, your ratio is 50%. I don't want to get too bogged down in the numbers, but this is a way to test. Think of it as a decision tree. We're testing, okay? What gives you the highest benefit for the longest amount of time, okay? If your ratio is under 16.5%, you claim your widow's benefit at 60, 61, not your own, okay? If it's in between, you claim your own and then switch. So this is a really important point. You can switch midstream, okay? You don't have to stay with one or the other, because you turn on one benefit and you let the other accrue those deferral credits. That's how, I don't want to say it like this, but that's how we get the most out of the system. Maybe we'll say it differently. That's how we get what we're entitled to under the law, right? Not the most out of the system, okay? Conversely, if your ratio is up here, right, over 63%, you claim your survivor benefit and you let that deferral credit ride until 70, okay? What you're doing is hedging against inflation for the long term.
Yeah, this is something that's very confusing. So I'm glad you actually talked about this, and we have some questions over here about this, because I think this is, honestly, I didn't know.
Yes, why would you? You've got to be right up to your elbows in this stuff and running these calculations with software. Like, I wouldn't want to do a tax return with a pencil, right?
Right.
And so, okay, let's jump into some.
Let's take a few questions, and we're going to do about 5 minutes of questions, and then because we want to try to keep this recording, and then we'll stop the recording and we'll continue to answer some of your questions. Because I think, can you see the chat? Kristina, kind of start at the top. Cindy says, I'm receiving survivor benefits now, but when I am 70, I am able to switch and receive. That's what we were just talking about.
Yes, you are a duly eligible woman.
Yep. You are duly eligible.
There you go. Okay. I'm not sure where the top of the chat starts. I will say this while I'm figuring my way through the chat. If anyone has specific questions that they don't want to share on the interwebs, just find me. Happy to run scenarios. And this is an area of planning that's incredibly specific. Nobody has your situation, nor your husband's situation. Nobody has your work record as you do. Okay. So, all right. Where are we at, hon?
Sherry says, I'm hoping to claim my husband's now and then switch to my own. She's 62 now, which means she should switch at 66 if she's if he was a higher earner, correct?
Or 70. So you're right, Carolyn. So let's say your full retirement age is 66 and you were a high earner throughout your working years. You get 8% bump up for every year you wait from 66 to 70. Now, there's no incentive to wait a day past your 70th birthday. So turn it on then.
Correct. Okay. Becky said, are taxes levied on Social Security benefits after I reach my FRA?
Yes. So plan on your Social Security benefits being taxed. 85% of your benefits are typically taxed unless that you have no other source of income. It is a wildly confusing tax calculation. If you earn by interest, dividends, other pension, other sources of income, I think it's something like $20,000, then yes, plan on Social Security benefits being taxed. If there are no other sources of income, generally no. Okay.
Good to know.
Yeah.
Corey says, my husband died when he was 59 before he was eligible for Social Security. I will be 60 this December, and I'm trying to get the benefits matrix from Social Security, but they told me that they won't let me get an appointment until 3 months before I turn 60.
That's true. And so, right, 60 is the earliest you can turn on any benefits unless you happen to be disabled. I don't hear that's the case. What I would do is get the annual statement of earnings, the last one you have from your husband, and I would hold yours side by each, and that would be a really good projection of what you'll be eligible for. Okay.
Right. Does the income limit include pension payments?
No, that is just wages.
Just wages. Okay.
You got
it. Here's a question you get a lot, I'm sure. Why is there an income limit? And why? And then it's taken away once you receive full retirement age. This doesn't make sense.
It's our government. I'm not sure. Nobody asked me. I play by the rules that we have. Gosh, so I'm not sure that I have a sufficient answer. My guess is going to be that it's designed as a fail-safe, as designed as minimum payments for older retired folks. And so it does what it's supposed to in that it dissuades you from claiming early.
Right.
Right. That's my best guess.
That's right. Does income limit include unemployment?
Yes.
Yeah. See, it all goes into income.
You got it. The most important number on your tax return is the line that says, and I can't even remember the line item this year. It's called AGI, adjusted gross income. Okay. And so everything filters into that. I can get you the line number if you want, but if your pension or your unemployment comp filters into AGI, that's included. So yes is the answer.
Here's a really good question, and we're going to stop recording and then we'll answer the rest of them. It's from Lori, because the reason why is because we're having a webinar next week about creating a new work life in widowhood. And because there's a lot of questions about how do I continue to earn money from 60 to 70. I mean, that is, we're living longer, we're working longer. So Lori has a question here. It's really important. My husband died at 58 and I will be 60 in January. His worker benefits are higher than mine. I know I'm eligible for survivor benefits in January, but I own my own company as a sole proprietor. Not clear if my Social Security benefits would be reduced based on my pass-through income from sole proprietorship. It sounds like yes.
Yes, absolutely.
Yes. I am not a paid regular. I'm not a paid regular paycheck. I'm not an employee.
That's right. And so you're right about that. I would be very hesitant to turn on benefits before your normal retirement age. That's exactly what's going to happen. Your survivor benefits are going to be reduced down to 71.5%. And you're going to be subject to the earnings test, which means when that K-1 comes through, when that pass-through income comes through, you file your return. The administration has paid you for the previous year. They give it and they take it back. So you're in that small, unfortunate camp of folks where if you apply for benefits early, they're going to ask for their $1 for every 2 back. And that's going to come next year when you go on record with your earnings.
Right. Right. So I just want to, we're going to stop the recording, but we're going to continue, guys. So stay on. I just wanted to thank everyone for being on the call, and thank Kristina for all this information. But we still have about 7 more questions, and we'll get this recording to everyone. But I wanted to thank everyone for being on this great educational series that we have, because this is a conversation we can have hours and hours, right? And I love that you're so readily available to answer them, because sometimes it is just this one question, right? I think our ladies are very educated, but it's like that. I'm not going to make this decision until I have someone I can professionally speak to that will help me. So I'm deeply grateful that you have been able to offer that for our ladies. And you guys can, I love Northstar. They have been extremely giving to our organization, sharing space, allowing our New Hampshire chapter to meet there for years. You're very devoted to widows, and I really appreciate that tremendously. So you can find Kristina at Kristina@northstarfp.com, or go to northstarfp.com website, and you'll be able to reach out to them. So thank you, Kristina.
You're welcome.